Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris rapeseed, Winnipeg canola, and Malaysian palm oil markets. I'll start with Paris rapeseed. The most recent move higher originated from the drop made in the changeover gap at the end of January. It started from where the market halted back then at the combination of the optimized February 2021 to date uptrend, currently at 638.5, and the rising long moving average, currently 639.75. Prices then utilized these two supports as a base for a move higher, slowly filling in the gap. The next big event was a shooting star pattern, type 1 bearish, 5 Thursdays ago. It was the largest example of such a pattern I've ever seen. However, the resultant move lower was limited to just the following Friday session, and prices soon started to move erratically back up again, which admittedly included a gapping higher action 4 weekends ago. The most significant recent action had been what looked like a strong move up over the 50% projected Fibonacci line at 750 even, which is from where originally we had so much bearish pressure back in early January. This made a new all-time high last week. However, this high was in the shape of a combined bearish dark cloud cover pattern and a bearish double. Since then, prices have not so much as edged lower as took a dip lower and ended up where we started from. So where does that leave us? Well, I must again refer to my annual review on Paris rapeseed, made at the very start of January this year. In this I refer to a hesitation that the market made, and I quote, "Between October and December last year on the long-term chart, this doesn't show so well, but it is there. Thus, this has led to yet another target topside. Target X2 is in the 834.5 area. I know this is a big ask, but I can only put down what I see." End of quote. This target is still up there, well up, off the top of my daily chart, but it's still there, though as I said earlier, it doesn't show up so well. This leads me to another comment I drew from my annual review, and I quote again. This leads to my final points. Since May last year, we have formed a newer, much more acute bull channel, currently 626.25 to 823.5. To me, it is super acute and thus unsustainable, but it is there, and I will not dismiss it just because of acuteness. End of quote. Well, this channel is still there, and I have transferred it and finessed it on this daily chart, such that I am more inclined to refer to it as the February/April 2021 to date ascending wedge pattern, rather than a bull channel. This pattern is the outlying, corralling, bullish influence on this market and may well show the way higher should prices choose once again to look that way. Whatever may happen, watch carefully to see if prices start approaching either trend line, but especially the lower trend line, as this runs parallel to the previously mentioned optimized uptrend, and perhaps more importantly, also runs parallel with a rising long moving average, currently 639.75. At this time. Winnipeg canola. Okay, so I've talked a lot about the sideways rectangle pattern between 945 even and 1038.60 that was formed since early November 2021 till late February this year, and how it had been triggered. The rising medium moving average, currently at 1024.80, may well have been what caused the move upwards, as the moving average had risen enough to impinge upon the market at the time. Prices reached up and exceeded target X for this pattern in the 1111 even area, and a further move higher ran into some resistances from 3 sources, and possibly a major resistance from a 4th. The first was the 100% projected Fibonacci line from the original rectangle at 1131.80. The second was the 50% projected Fibonacci line for the big action 3 weeks ago at 1142.90. And the final of the 3 resistances at the time was a new upper time, currently 1180.40 of the mid-January to late February bullish Andrews pitchfork. This upper time was breached repeatedly, but not broken. The fourth major resistance was a market function. It was the changeover gap, 1097.20 to 1114.60. This gap has tempered the market's attempted moves higher, such that though we have new all-time highs last week, it has been at what cost? Initially, the market found some support in its attempts higher and some bullish incentive from the rising middle time. Plus, interestingly, the short moving average, currently 1112.40, and the 50% projected Fibonacci line at 1085.10. However, yesterday was the first close below the short moving average and the middle time in recent weeks, and earlier this week the 50% projected Fibonacci line was breached, though it still remains the only one of the three to still be support. Thus we have some serious attempts higher, but though it made a new high, it has ended up lower and seemingly pausing for breath. It is at this point I should make a serious point. You see, it is way too early to call this market bearish. Only if we have consecutive closes below the lower time, currently at 1077.60, can we even entertain that this is just a breather otherwise in the market. One attempt down to this lower time this week failed to come close. The second one today has also failed to really come close, but the pitchfork is quite acute and another attempt ought not to be ruled out. Bursa Malaysia crude palm oil. The September to December 2021 bullish Andrews pitchfork had until the end of February been the most recent driver in moving the market higher. Then 4 weeks ago, prices broke above the upper time, currently at 72.66. But then had some apparent consolidation as prices next moved over the 50% projected Fibonacci line at 74.92 before stalling ahead of the 100% projected Fibonacci line at 81.96, and then dipping back down into the depths of the same pitchfork. However, the dip was limited largely by the significant late February highs between 67.81 and 67.90, which generated another fresh attempt higher, organized from a combination of an immediate countering key reversal up, a bullish engulfing pattern, and a bullish opening long white Mariposa. Prices made it back above the 50% projected Fibonacci line at 74.92, but not much further, before 3 weeks ago, on the Friday, making a significant combined key reversal down and bearish engulfing pattern. This set the stage for the extraordinary moves lower we have seen since. 2 gapping moves lower that have seen the market drop and test the rising short stroke medium moving average, currently 61.20, and approach both the lower time, currently 58.80, and the Fibonacci congestion area, 56.42 to 57.10, before back up and getting capped this time by now the overhead middle time, currently 66.69. Since then, by the way, this was last week, we have seen prices drift lower and attempt once more to overcome the rising short medium moving average from the top side, most notably today, with a combined key reversal down and bearish engulfing pattern. We've yet to see if this strategy works. So what has the market achieved in all this action? Well, the immediate consequences have been twofold. Firstly, we have a double top for the late February to date action. Now, I have been conservative and measured this possible pattern from the second top, not the higher first top. Thus, we have an initial target X, or had an initial target X in the 57.65 area, with a secondary target X1 in the 54.35 area. The initial target X was reached 2 weeks ago. The second thing to observe is that gaps in the market on the way down are roughly bisected by the rising tines of the broken September to December 2021 bullish Andrews pitchfork. This is the pitchfork that has been showing the bullish angle of attack of the market until very late February. Now, all this may be coincidence, but I'm inclined not to think so, and that these gaps may be an echo of the previous tines. That is why I've kept this broken pitchfork on the daily chart, and would suggest that a special watch be made on the tines, especially in recent days, the lower tine, currently at 58.80. These tines from a previously broken pitchfork may still seem to be effective, support and resistance levels, and until the lower time is properly broken, the market will still have the bullish incentive. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.